Tech investing secrets that actually work, cutting through the hype. The tech sector promises explosive growth and revolutionary change, but it's also a minefield of hype, volatility, and fleeting trends. Finding genuine, sustainable success requires moving beyond chasing headlines and hot tips. Here are real, actionable tech investing secrets grounded in fundamentals and long-term thinking. Secret number 1. Focus on the why behind the moat, not just the moat itself. What it means. Everyone talks about economic moats, competitive advantages. The secret is understanding why that moat exists and how durable it really is. How to apply it. Don't just accept network effects or brand at face value. Dig deeper. Network effects. Are they defensible? Can a competitor build a bigger or better network, e.g., Meta versus newer social apps? Switching costs. Are they truly painful for customers to leave, e.g., Adobe's Creative Cloud versus a point solution? Intellectual property. Is it continuously innovated and legally protected, e.g., NVIDIA's CUDA ecosystem and patents? Scale. Does it lead to sustainable cost advantages competitors can't match, e.g., Amazon AWS infrastructure? Why it works. Understanding the source and strength of the advantage reveals if it's truly long-lasting or vulnerable to disruption. Secret number 2. Embrace the anti-trend principle. Look where others aren't. What it means. The biggest opportunities often lie outside the current frenzy. While everyone chases the hottest AI stock, look for enablers or underappreciated applications. How to apply it. Look downstream. Who sells the picks and shovels to the gold miners, e.g., semiconductor equipment makers, ASML during any chip boom, cloud infrastructure providers during the AI rush? Look for adjacent needs. What new problems does the hot trend create, e.g., cybersecurity for AI models, data management for IoT? Seek maturity in disguise. Established tech companies successfully pivoting or integrating new tech, e.g., Microsoft embracing cloud and AI. Why it works. Avoiding the hype cycle often leads to better valuations and identifies companies with proven execution capabilities applying new tech, not just buzzwords. Secret number 3. Prioritize optionality and management agility. What it means. In fast-moving tech, the future is unpredictable. Invest in companies that have multiple paths to growth, optionality, and leadership capable of navigating uncertainty and pivoting effectively. How to apply it. Strong balance sheet, ample cash reserves provide fuel to acquire, invest in R&D, or weather downturns. History of innovation. Has the company successfully launched new products or entered new markets before? Capital allocation skill. Does management invest wisely in R&D, acquisitions, and shareholder returns? Are they transparent? Adaptability. Look for evidence of strategic pivots in response to market shifts. Why it works. Companies with resources and agile leadership can capitalize on unforeseen opportunities and survive disruptions that sink less prepared rivals. Secret number 4. Time in the market trumps timing the market, especially in tech. What it means. Trying to perfectly time entry and exit points in volatile tech is a fool's errand. Consistent investment over time, dollar cost averaging, and holding through volatility for fundamentally sound companies wins long term. How to apply it. Automate your investments. Set up regular contributions to your tech holdings. Build conviction. Invest in companies you understand deeply and believe in for the long haul, 5 to 10 years plus. Tune out short-term noise and focus on quarterly or annual progress against the thesis. Reinvest dividends. If holding dividend-paying tech, compound your returns. Why it works. Tech growth is often non-linear. Missing just a few of the best days significantly reduces long-term returns. Staying invested captures the full growth trajectory. Secret number 5. Understand the law of large numbers trap. What it means. Hypergrowth rates are unsustainable forever. As companies become massive, maintaining high percentage growth becomes exponentially harder. How to apply it? Be realistic. Don't project startup-like growth rates onto trillion-dollar companies indefinitely. Look for new growth levers. How will the company find its next billion-dollar business, e.g. Amazon, e-commerce to AWS to advertising? Focus on profitability and cash flow. As growth inevitably slows, sustainable profits and strong cash generation become critical valuation drivers. Adjust valuation expectations. High growth multiples are often justified for small caps, but become dangerous for mega caps without massive new markets. Why it works. Prevents overpaying based on unrealistic extrapolations and helps identify when a company needs to evolve its business model. Secret number 6. Portfolio hygiene is non-negotiable. What it means. Tech investing involves high risk. Managing that risk through diversification and disciplined selling is crucial. How to apply it. Diversify within tech. Don't just buy 5 software stocks. Spread across subsectors, semis, cloud, cybersecurity, fintech, hardware. Consider thematic ETFs alongside individual picks. Know your exit criteria. Define before investing. What would make you sell? E.g., thesis broken, valuation extreme, management failure, better opportunity? Stick to it. Trim winners. Periodically rebalance. Taking some profits off the table after big runs locks in gains and reduces portfolio concentration risk. Cut losers ruthlessly. If the core thesis is invalidated, sell. Don't fall for the sunk cost fallacy. Why it works. Protects capital from catastrophic losses in any single holding or subsector meltdown and ensures you capture gains. The ultimate secret. Patience, process, and perspective. There are no guaranteed shortcuts in tech investing. The real secrets boil down to deep fundamental research, understand the business, its moat, its management, and its financials inside out. Unshakable long-term conviction. Believe in the company's mission and its ability to execute over years. Ruthless discipline. Stick to your strategy, manage risk, and avoid emotional decisions. Acceptance of volatility. Tech will have brutal corrections. See them as potential opportunities if your thesis holds. Continuous learning. The tech landscape evolves relentlessly. Stay curious and informed. By focusing on these principles, understanding durable advantages, seeking value beyond the hype, prioritizing adaptability, investing consistently, managing growth expectations, and practicing rigorous risk management, you significantly increase your odds of finding and holding on to the truly transformative tech winners. Forget the get-rich-quick secrets. These are the strategies that build lasting wealth in the dynamic world of technology.